Thanks, everyone. To start off, can you guys introduce yourselves? I think everyone's pretty familiar with the institutions you're from, but one or two lines about how your institutions and your role with tokenization, or how your institutions are using tokenization today.
I can go ahead and begin. So nice to meet you guys. Christopher Jensen from Franklin Templeton. Big global asset manager, but what we're doing in digital assets is really fourfold. I think of it as kind of two strategies on the building side and two on the investing side. So on the investing side, we're putting together token portfolios and also have an early stage venture fund. And on the building side, we run nodes across, I think, 10 different blockchains right now and do staking. And then we're also, that fourth prong is really what this panel is about, RWAs, tokenization. So really see that as a big trend and one that we're focused in. So our team is comprised of everything from fundamental analysis, TradFi guys and quants over to a lot of actual blockchain engineers trying to make this happen and how we can connect the dots between TradFi and kind of crypto.
Awesome. And I think, is Benji the largest TVL of any RWA asset today on Ethereum?
It is. So Benji is the product for our tokenized money market fund, which, if you go to rwa.xyz or something, we're right up there at the top. About 300 million in AUM in that product.
Get one of these just to walk around
San Francisco.
Thank you very much.
Hello, everybody. I'm Eric Sarnecki. I'm one of the co-founders of Digital Asset. We're actually a technology vendor to institutions like Franklin Templeton, not a customer yet. Where we provide the smart contract language DAML and the blockchain Canton to enable customers to launch products like Benji that were just described into a large interoperable enterprise ecosystem that we call the Canton Network, which we launched in May with 30 different participants.
Hi, everyone. My name is Mona Elisa. I founded the first on-chain asset management protocol in 2016 called Enzyme. And Enzyme enables people to set up tokenized funds on the blockchain where the management of those funds takes place on-chain. The entire operational and administrative aspects of the fund is automated through smart contracts, and you get, obviously, the transparency of the blockchain as well. Really importantly, the fund tokens are redeemable for the underlying assets in the fund, allowing investors to hold custody of their assets at all times.
Hey everyone, I'm Tyron Lobban. I work at JP Morgan, sitting within our Onyx business unit. The way that we're using tokenization is obviously tokenizing traditional assets. We have a platform called Onyx Digital Assets. We're doing about $1 to $2 billion a day of traded notional through the platform. Since we launched in 2020, we've done about 900 billion of different types of assets. We're tokenizing US Treasuries, mortgage-backed securities, also money market fund shares, and in the future we'll be looking at things like alternative investments. And really the idea here is to be able to not only create efficiencies for our businesses and for our clients, but also to generate new revenue. So there's a big driver around that, and ultimately just bringing utility to assets where you have trapped liquidity or trapped assets and actually providing new utility to them.
Awesome. So I'd like to start with a little history. We may all remember in 2017, the tagline from TradFi was, we don't really believe in crypto, but we like the blockchain. And fast forward to today, we have a great panel with some really important institutions who are experimenting in crypto. So Tyron, if you could give us some history about and perspective of the transition from private institutional blockchains to maybe more public, or what you guys are using today. And Eric, I know you have really interesting opinions on where that's going to go in the future.
Yeah, and maybe I can just provide a little bit of context in terms of just the traditional financial services market and how we think about the requirements really to be able to operate a safe and sound system. So JP Morgan processes about $10 trillion of payments every day. That's 400 times the global stablecoin daily volume. The global FX market is about $5 trillion. And so when we think about utilizing blockchains as a settlement layer, we need the infrastructure to actually support these volumes, and we need them to support the scale that the traditional financial services market is at. So right now, clearly, there are a number of reasons, both technological-wise, but also regulatory-wise, as to why we have to use permissioned blockchains. However, you can think about these globally ever-present, always up, highly redundant public blockchains as a really, really attractive settlement layer that can service this global market. However, until we actually solve some of the key challenges, specifically around privacy, specifically around things like AML, KYC, it does become difficult for us to fully step into that environment. We did a project last year with the Monetary Authority of Singapore where we demonstrated what it would actually look like for a regulated institution like ourselves to utilize public DeFi protocols, to utilize public blockchains. And very clearly, there were lots of very insightful learnings for us. The transparency that you get around DeFi pools, for example, the ability to have anytime price discovery through a DeFi protocol, very, very important and interesting. Also, the lower cost. But as I said, until we actually have some clarity around the ability to actually operate on this infrastructure from a reg perspective, we're going to have to be in this sort of permission view until we can take some of the hybrid steps. And those hybrid steps look like some of the existing infrastructure that is coming out right now around subnets or permission zones or these kinds of things. And from our perspective, the reason why we operate an EVM sidechain is so that everything that we build can actually be portable into a public environment. So all of our contracts are written in Solidity. We use ERC20s for the most part for our tokens. All of our developer tooling utilizes the public Ethereum ecosystem's tooling set. So actually moving into the public blockchain environment when we can will be much of a sort of a lift and drop scenario.
Awesome. Eric, what do you think?
Well, maybe I'll repeat the trick question that I asked you before. And so what's the most successful public permissionless network in the world?
Should I give the real answer or the one that I gave?
Give the one that you gave.
I said Bitcoin.
Yeah, OK. I think that's a reasonable thing given the environment that we're in. But the real answer, in my opinion, is really actually the internet. The protocol is permissionless. The ecosystem is permissionless, completely public. There are unbelievably horrible, nefarious things in the internet because of that permissionlessness. And yet you'll find JP Morgan side by side with some of those awful, nefarious things. The key separation is not, is the network permissionless and thus all the apps are permissionless. It's how did we create an ecosystem of permissioned apps in a permissionless network. And that's really important because when we get all different types of permissionless innovation in the internet today. People can launch any type of business that they want. It's accessible to all of the users in that ecosystem, but that doesn't mean I get to see every customer's balance at JP Morgan. And if JP Morgan has enabled me to access those APIs, I can fold that into a new service and create Plaid. I can create lots of value on a certain level of permissionless innovation, but again, I don't need to be able to have full access to the data that JP Morgan manages. So I think that actually this public-private is a false dichotomy because the definitions are too broad. We need, frankly, we must have public permissionless networks because this is all about interoperability. This is all about synchronizing markets. It's all about synchronizing data. It's about leveraging assets that have otherwise been siloed. So it has to be a permissionless ecosystem, but you have to give institutions like JP Morgan and Franklin Templeton the tools to be able to guarantee the privacy of the data of their customers, to be able to guarantee the SLAs of their business. Imagine if they had a big bond auction and CryptoKitties went crazy and the network was just very slow processing transactions. You're interfering with real business, and that's going to cause a regulatory problem for them. So you need to be able to guarantee the SLAs of your app, your control of the app, the privacy of the data in your app, but you have to be part of a bigger ecosystem. And that's why we launched the Canton Network. We launched a new blockchain ecosystem that gives you exactly that capability. Every one of our customers defines and controls their data, their system exactly as they see fit, but it's perfectly interoperable with everything else in the ecosystem. So
just very quickly, that exact scenario that Eric described actually happened to us. So when we were doing this transaction on public chain through Aave, there happened to be an NFT drop, like a Reddit NFT drop. And all of a sudden, our transaction was not going through. We had this, FX trade that we couldn't actually execute. Obviously, we had to, up the gas and make sure we could actually push it through. But you can see how that model can't work when you're looking at global financial services markets.
Yeah, and people mistakenly call this a transaction per second problem. It's not, it's a segmentation problem. How many billions of packets per second are going across the internet today? We don't even talk about that because the scale is so huge. You could service a single company at tens of thousands of transactions per second, but you need billions per second to service the global network financial ecosystem. So you must have segmentation, you must have separation, you must have separation of concerns, and independent workflows should have independent infrastructure, but you can't sacrifice interoperability. That's the big prize in all of this. So that's where I'm quite empathetic to everyone that says, I think the previous panel said, beware private blockchains. Could not agree more. Private blockchains completely throw out interoperability in exchange for trying to give you back some of these controls. You shouldn't have to sacrifice. You should get both. If you're picking a blockchain, pick one that gives you complete control and interoperability. It does exist. Go with that one.
And you don't think those solutions can exist on an EVM blockchain? Or?
No.
Okay.
No, because an EVM blockchain is designed to assume that it sees everything and it consumes everything, and it has a shared pool of validators. And it's not designed for privacy, interoperability, and granular control. It's a horizontal, you guys, I think yourselves maybe coined the phrase fat protocol. I think is a big Masari thing. And so,
yeah, and not our phrase, but definitely we've used it.
Okay, so fair enough, but fat protocol means it's leaking up into your app and dictating things in your application, and I think that potentially the EVM is too fat for capital markets purposes.
Okay. Okay, so bouncing off of that, one of the big pitches for tokenizing assets and for getting them on public blockchains is that you'll have deeper secondary liquidity and bigger pools of liquidity for more efficient markets. If we have to do tokenized assets in permissioned locales and pools, is the promise of deeper secondary liquidity fraudulent? Is that ever going to be realized? Or is the nature of this stuff needing a guard for the on-off ramp in meat space or RWA always going to keep the liquidity pool the same as it is?
I don't think I know of any examples of real-world assets that have been tokenized and actually managed to tap into that deep liquidity on a public blockchain, just because the rules around security transfer are so complicated and so different according to jurisdiction. Unfortunately, the rules around securities transfer law were written for paper-based 18th century financial world. They certainly weren't built for a world of efficiency and automation. And so they need to be completely rewritten from scratch for anyone to be able to access those benefits, liquidity, transferability on-chain, with new considerations. I don't know about on a private blockchain if it changes anything, but I think you still have quite a lot of complexity there as well.
Yeah, I think the deeper liquidity is not the prize in RWAs. It's the reduction of the friction of being able to provide interoperability. You talked about all the payments that you guys do. That's for a settlement of some security somewhere else. Your system is not interoperable with that other system. Often someone sits in the middle and is coordinating that. Yeah. That friction, that counterparty risk, the margining that is associated with it. If instead you could have a DeFi-like settlement, you could do true DVP, there's a lot of costs you could remove.
We see it a lot in the fund space. We're in the asset management hedge fund. We're trying to disrupt the intermediaries in the hedge fund world. But the law states that every hedge fund has to have a fund administrator and a custodian and have their NAV independently verified by the fund administrator and. Yeah. But when smart contracts completely automate and disrupt that, and the whole point of that is that you can remove the intermediaries to get the efficiency, lower cost, more transparency, more security, and actually the law forces you down the route of using the intermediaries anyway. So it's a problem that we see everywhere in this field.
But you've done a good job of automating them so they're still efficient.
Yeah, we have. And we've also managed to still cut deals with fund administrators and say, well, now that we're automating your job, maybe you can slash your fees by 80% and we can still work together. We benefit because we're compliant and our end users benefit because the end product is much cheaper. But ultimately, it's still friction, and it's just, so much work to do in terms of rewriting financial law for these new assumptions. financial law today is still written for paper-based securities, which rely on intermediary to enable trust between financial participants. But today, a public blockchain can ensure that trust because everything is peer-to-peer and automated in smart contracts. You don't need those financial intermediaries to give those guarantees to users at the end of the day. And so with those new assumptions, we have to rewrite law to like adapt for this new world. And that's quite a lot of work.
Go ahead, Christopher. Sorry.
We often get asked, what's the value of blockchains? And over the years, we've been trying to simplify this answer. And one that we currently like and give a lot is that it decreases the cost of trust, right? And so I think as we're thinking about the use case for RWAs and tokenization, that's a big component of it. And this feeds into public versus private. So at Franklin Templeton, there's definitely an ethos of blockchain and decentralized and permissionless infrastructure. So where we can, we try to have the information that state of record live on chain and only live on chain, and these are on public blockchains. So we started on Stellar. We're also on Polygon. We wanted to weigh into the EVM, and right now we're in development with 3 more chains. So Avalanche, Arbitrum, Aptos, and this also gets into how we think about the roadmap and interoperability and being able to transfer and move capital amongst these different public chains. But you mentioned privacy, so all the PII, the personally identifiable information, that stuff is obviously off chain. But all of the transaction activity, subscriptions, redemptions, dividends, that source of truth exists as a ledger, on chain, and that's what the transfer agent uses as the source of truth. So we're structured as a security token, and when we got that permissioning, initially we had to run it parallel path on blockchain rails and on TradFi rails. And once they got comfortable with it, and I think this is pretty unique here for us, is that we were able to do away with the TradFi rails, and this system of record now exists, wholly on blockchain.
And it's permissioned assets, so they have to KYC with you guys in order to be a permissioned address. Yep. Then you can trade the Benji tokens. Yeah,
so for that we use kind of a web-based fintech front end to do that, where you can kind of KYC AML in. But once you're in, there's a record of ownership of the Benji token, and that's the thing of value, right? The token itself is what entitles me as the shareholder to shares in this fund. And I think you mentioned kind of funds and record of ownership there. And I think once you have that model set up, then you realize, hey, you can do this with anything. It doesn't have to be tokenized treasuries, which is very hot right now, obviously with rates the way they are, and stablecoins not earning a lot of yield. But this model of where you can tokenize the fund shares in a fund, where the underlying collateral could be anything, you really see how you can kind of roll this out with other asset classes as well.
Can I just jump in very quickly with a point around this permissionless access to like DeFi pools? We often talk about blockchain being the internet of value, bringing the internet of value. But if you just listen to the words that we've been speaking on this panel, subscription, redemption, transfer agent, fund admin, custodian, these are not things that are relevant in the internet of information, right? The internet of value is a very different place to the internet of information. And unfortunately, that requires a lot of controls and it requires a lot of compliance, which is not something that anyone in our industry really wants to necessarily have to deal with, but it is a reality when you talk about value transfer. And but so, just super quickly, when we think about permissionless access to these DeFi pools, I don't know that you ever get there when you talk about securities and we talk about the fact that you have to meet compliance requirements around sanctions and around AML and around KYC. There will be ways to improve upon how that is done today. I don't know that you ever fully get away from it, though. Sorry, Mona.
No, I don't think, we've built our infrastructure from day assuming that that we have to fit into a regulated and compliant world. I don't think, at least I'm not arguing against the need for compliance. I'm just saying that we can automate compliance
totally
through smart contract, we can automate risk management, operations, administration. We don't need to rely on centralized parties. And actually, smart contracts and public blockchains give you higher guarantees around security and risk management, because you don't have to settle with T+2 and T+3 where you have blind spots where you don't even know if you've done the right trade until 2 days later. You have this immediate settlement, so you can code in pre-trade checks, post-trade checks. It just gives you a massive, but we're just not there on the, and I think anything can be automated and coded in from a compliance perspective, but what needs to catch up is that, regulation or even just law needs to catch up to the modern day technology and just recognize this technology for the efficiency. It's not the what that's changing in tokenization and DeFi, it's the how.
Yeah. No, I couldn't agree more. My only point is I don't know if we get to permissionless, because everything you said requires permission.
Yeah. No, I think I agree with that.
That was my question. They're on permissionless chains. Can I withdraw Benji and put it in my own wallet?
If you're a Benji holder, you withdraw. Oh, so it's self-custody?
Yeah.
So, I mean, just like a protocol, we have our roadmap, and that is, there's a couple things right at the top of the list, right? The ability to transfer. So if I'm KYC'd in and you are, I should be able to, I can do that with TradFi, right, securities, so I should be able to do that with digital securities, right? Another is self-custody, whether or you can custody it with yourself or just to control that, right? So that's, I would not say next, but it's in this kind of highest priority bucket of additional.
I didn't mean to put you on the spot. I think it was just additive to the point, which is even when you're in a permissionless ecosystem, you have to implement a ton of control around that. Right now, you guys still control the tokens on behalf of the customers. That will change over time, right? But
yeah. At the end of the day, again, we chose to go the security route, right? So at the end of the day, this token is still a security.
Yeah.
So then the question becomes, well, what value do you get from putting this on chain? And I think people see a lot of extra utility and value the further you go down the roadmap. But even now, by the ability to run the actual fund so much cheaper, and not a 10x cheaper, right? Or not a 10% cheaper, but a 10x cheaper. It really is that materially different. You were asking about kind of fees and flow through. So we can, because we run the fund cheaper, we can pass that through, right? So you could realize a higher yield because we can run the fund cheaper. And then another use case or part of the value proposition is because it's on chain, like literally it's on the block explorer. I could go look at that system of record and see what I own and when the last dividend was, where I don't have that transparency with a centralized database that's behind kind of a walled garden. So part of what we're doing is trying to make the case like, hey, this is better, safer, to actually have it out there on a permissionless chain. And then once that additional utility comes, I think that's when you get to these extra value add that crypto brings. Not just making it cheaper, but to do new things that can't be done on TradFi rails.
I think what you said last is maybe the most important part. We heard PayPal earlier. Yep. He seemed pretty excited about how often he was surprised by where PYUSD had been incorporated, right? So the comment you just made before about this data is available. Well, a third party could build a better reporting system, right? When it's all centralized, you rely upon not just your custodian to provide those services to you, but you have to trust it as well. And if instead you could just rely upon those core services and a whole ecosystem of value added on top of that, I think that's the permissionless innovation we'll see in RWAs, is not deep liquidity pools and permissionless DeFi. It'll be, okay, I no longer have to get everything related to my deposits from my custodian. I can get some services from them, some services from third parties, and overall I'll get a better enriched process over.
I think the other thing that's actually really valuable when we talk about permissionless is not having to get permission to validate that this code is going to do the thing that I think it's going to do, right? The transparency that you get with open source, open access software is actually incredibly valuable. So even if the access to assets might have to be controlled, the independent validation that you can do around how a function is performed, and that you can start to, as Mona said, reduce a lot of the inefficiencies around all of the post-trade is actually hugely valuable.
Is there a middle ground where you can have all the PII done and from some government-regulated body and then enforced as an on-chain like digital credential or identifier. And then anyone with this identifier, it doesn't need to be a Franklin Templeton KYC or JP Morgan. Anyone with this KYC credential can now access the liquidity and trade these products.
Yeah, that's actually pretty much exactly what we did last year. So we implemented a system based on verifiable credentials where a trader at JP Morgan, for example, could get a credential that says, you are an employee of JP Morgan, you are authorized to trade on behalf of the company up to some risk limit. And then those credentials were actually provided on-chain, so actually sort of attached to the transaction that was sent to a DeFi pool. And then before the transaction hit the DeFi pool, we built an on-chain verifier that verified all of the accuracy of that information, completely trustlessly, not having to go back into JP Morgan systems to verify it because it's all cryptographic. The really interesting thing about this is now you have a verifier that knows how to validate a trader credential. Well, I can go and take that same verifier and use it in some other protocol completely away from the system.
Yeah.
And so you can start to build up this really nice sort of composable identity layer that is based on trust. It's based on these credentials that are issued by trusted actors, but that give access in a privacy-preserving way to on-chain finance.
Do you guys think there's any more important standard that's needed for off-chain asset tokenization than verifiable credentials on-chain?
It's a big one.
Yeah, hot take question.
Any more important standard?
Any more important standard? Or do you think that's the most important one? If we can agree to that, it speeds things up dramatically.
Look, I think that the identity layer is the missing piece right now in public blockchains. I think, and obviously it was designed in this specific way because it's meant to be an anonymity preserving environment. When we talk about traditional finance on-chain, it's a slightly different paradigm. And so having something like a strong identity layer through verifiable credentials is important. The only other thing I would maybe say is equally important is if we're going to be representing assets on multiple blockchains, then there does need to be a standard that is recognized across those chains, right? I need to know that if I'm representing a treasury or this is how a coupon is paid, on an Ethereum blockchain, and I want to move to a non-EVM chain and have interoperability between those, I want to know that the asset is going to behave the same on those two places. So I think we're a little bit, there's obviously been work in the industry to create ERC20-like tokens in other environments, but I don't know that they're legally recognized.
I think the big missing primitive is the off-chain on and off ramp. Probably you've had some experience with finding transfer agents, custodians, auditors, finding all of those institutions that can build digital-friendly services. That'll be a big enabler. Because we've come across a lot of people that are interested in issuing into these ecosystems, but the on-ramps are high friction. And the other missing primitive, I would say, is distribution. No one wants to issue into an empty audience. People want to issue into where are their buyers, where does this asset have utility, where can I apply it onward to something else. So you need utility and distribution, but distribution to me seems to be the big missing one. People think, okay, I just showed up at Ethereum, this is a pool of just ready and able buyers, but more often than not, that tends not to be true.
Isn't that a permissioning problem, though? If I was allowed to buy any asset and someone started putting all these tokenized mortgages, CMBS, those are great opportunities that I think there's going to be a ton of demand for.
I'm not so sure. I'm lucky enough to have a financial advisor and all that sort of, there's a lot of infrastructure that supports how I manage my money. I'm not going to suddenly bifurcate my own workflows to get access to some assets in another zone. I need my RIA to be able to go over and do that.
That's a great point.
We need integration on the onboarding assets into this ecosystem. There's been a lot of focus on that. I think the underappreciated zone is how do I distribute that to the investors that are not blockchain native, and even if they are, may not, for other reasons, be able to directly participate. So I think that's probably the biggest underinvested area that I've seen.
Mona, I want to ask you a question. I think you have a pretty unique perspective up here on tokenizing because what your protocol and product does is actually tokenizing crypto-native assets as opposed to off-chain assets. Can you talk about some of the benefits of tokenization outside of bringing off-chain assets on-chain?
Yeah, so because we never touch anything off-chain, everything that is held inside a fund token on our platform is fully transparent in a fully verifiable and auditable way. And that gives you some very, very unique properties which you just can't get when you're tokenizing an off-chain asset. And those properties are provable transparency, 24/7 reporting, being able to maintain that non-custodial aspect. So your fund token, if it's in your wallet, can be redeemed for the underlying assets at any time. No one can unbank you. No one can censor you. No one can say, sorry, you didn't pass the KYC test this week. We're not, or guess what? You hold a Russian passport. This is a US dollar denominated asset. You're not getting this asset. You cannot redeem this asset. Everything you hold in that fund token is yours at all times. And then last but not least, because of all the automation aspects, you get much lower cost structure, which generally speaking brings down fees in the industry and enhances your returns.
I thought the redeemability is super interesting because you can have, you can invest in funds, and when you want to redeem, it's not like you get a US dollar redemption. You can get the individual tokens if you want.
Yeah, you can actually get a single asset depending on how the fund is customized as well. But the point is that that token entitles you to a redemption. The other benefit I forgot to mention is because you're only trading peer-to-peer on other DeFi protocols, you also eliminate counterparty risk. So if you're never going to have your assets on an FTX that goes bust. You have assets in a fund vault. You trade maybe on 0x in the same transaction. The assets come in. The assets go out and come in the same transaction.
Madoff could not have been built on Enzyme.
Yeah.
That's super. And I remember from TradFi, we used to have these huge days, trades versus NAV, rebalancing indices, which changes dramatically if you're tokenizing on-chain assets. Yep. Okay, one thing really quick first. Can you just tell us how long did the journey last for Franklin Templeton to get security tokens on-chain?
We started in 2018.
Amazing. And you listed it this year, right?
Last year.
Last year.
On Stellar. This year was Polygon.
So the reason why I ask is I'm surprised I haven't heard you guys whine about policy regulation as much, which kudos to you, build through it. But is this a huge issue and headwind? And in which ways?
Yeah, I can jump in a little bit. And actually, well, firstly, I know the pains of going through all this to get this live, so congratulations to you guys. For us, getting a product live, literally from like day one idea to, hey, this is now out in the world, is about 2 years. That's like the average that we've seen for our projects.
About the life of a typical DeFi protocol.
Right, exactly. We've seen a few come and go before we actually get one out. But yes, there are reg headwinds, but actually a lot of the reasons why it's difficult to do this is because we operate within regulated financial institutions, right? So you have regular way compliance, regular way legal considerations that you have to work through. The technology aspect is probably 10%, maybe 20% at most. The rest of it is everything else around. So all of your operations, all of your controls, how you go about handling things like defaults, what are the actual provisions when you are offering this product for the first time, how do you actually take that to market? There's a lot of just regular way stuff that you have to do. So when I think about regulatory headwinds, yes, they're there. And if there was one thing I would personally want is the ability to utilize public blockchains as a formal books and records within the United States. This is actually something that is available within many European countries, so you can actually transact and transfer ownership from one person to another over a blockchain in places like Luxembourg and Germany. You cannot actually do that on a public infrastructure today in the US. So if we could get something like that, we would actually have a huge boon in terms of being able to issue like bonds on-chain and being able to transact them.
Say it one more time. What was the actual thing you want changed?
So being able to settle like securities transactions on-chain, utilize a blockchain infrastructure for transfer of ownership of securities. There are a few states in the US that have actually looked to do that and actually I think have done that, but it's not something that's available across the whole entire US.
Do you guys have anything on the top of your wish list? If there's one thing that you could get clarity on?
transferability and custody of these security tokens, I think, is really important. And like I said, that's the next priority of features we're trying to unlock. In the States, I think the regulatory stuff, it is a headwind, but I think it's also a catalyst. And we do have a very good dialogue going with regulators here in the States, and getting things done, but at a slower pace than we would like. But then I think we take a lot of also encouragement on the global stage. We're a big global firm. I was just in Singapore last week, and we have offices there and all around the world. So we're very encouraged what we see overseas. Right now, Franklin Templeton's digital asset presence is predominantly US based, but that doesn't match our actual global footprint. So I think there's more to be done there overseas as well.
Awesome. If you guys want to share how people can reach out to you, and if there's anything you're hoping to hear or people you're hoping to get in touch with, close it out.
Sure, probably. LinkedIn is good, and then we can take.
You are so tradfi.
I was going to say, but then we can take a conversation over to Telegram. I'm less active on the Twitter side of things, but because we're investors and builders in this space, we love getting connected with anybody looking to kind of build and innovate here, right? I have a long background in private credit. I think half my meetings here at this conference are with people trying to get private credit on chain, whether it's in this jurisdiction or others. So, all those conversations are great. At Franklin, our digital assets business reports right to the top, to the CEO. So we're in this for the long game and really looking to kind of build and be investors in this space.
Awesome.
I very intentionally do not have any social media presence. No LinkedIn, won't touch any Microsoft product. So anyway, you can find us at canton.network and find out everything about the network, our participants, and how you could utilize our technology.
Yeah, on our side, you can find us on LinkedIn or Twitter, Avantgarde Finance or Mona Elisa, if you want to reach out to me directly. And we're always interested hearing from people in the asset management space, either crypto natives or institutions who are looking to get into on-chain asset management in a secure and compliant ways. And we're also very interested in looking to explore different distribution models for on-chain asset management products.
Awesome. And on my side, jpmorgan.com/Onyx. We're very focused right now on tokenizing asset management products like money market funds, alternative assets. So working with a number of players in the space, but if we haven't spoken, please come and speak to me afterwards. And then, although Eric and team have done an amazing job with Canton and the privacy solution, I think privacy is one of the missing pieces as well. We're doing a lot around privacy, so if you're working on privacy within an EVM stack, also happy to chat.